Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Juliet Sarli. We are coming to you a little earlier than normal today because, of course, we've got the last call. But let's have a look at where markets are tracking. It has been a day where we've seen some gains coming through today, and we're up by about 1/3 on the SIBO 200 index. This, of course, after what has been a pretty ho-hum week in terms of what we've seen more broadly across the markets. Of course, we didn't get much price action in terms of direction from overseas with the US closed for Thanksgiving. So when we look at some of the themes that we've been really following across the course of the week, it is kind of this ho-hum week because the gain that we've seen today has pretty much just offset the loss that we were already at over the 5 days to today. And that's, of course, as we took in a raft of offshore moves and particularly some big moves coming through in commodity prices this week. You did, of course, have a little bit of a reversal too in the China story with those property players. I'm looking as well at Origin. Of course, that shareholder vote has been pushed out and we did see a bit of momentum coming through in Origin rallying today. And then retail reality. You know, we know that these higher interest rates are starting to bite, and I think this week we've had something like 3 retailers come through, and Adairs was the latest, the homeware retailer today at its AGM, saying that it's seen sales for the first 21 weeks of this financial year down by some 9%. Earlier in the week, we heard a similar theme coming through from Lovisa, and then of course we also had Country Road warning too. So what does all of that mean? Is it going to be a bit of a dismal Christmas for the retailers? Certainly a number of these higher rates, higher living costs. My WhatsApp chats today with my friends have all been about how expensive our electricity bills are, really starting to bite the average consumer. Let's have a look at some of the sectors. I mentioned, of course, the move in Origin, and that has helped a lot of the utility stocks today. Origin not there, but we'll get to that in a moment. AGL up by about 0.8%. Speaking of higher energy bills, and having a look at the metals and mining space as well. BHP up by about 0.4%. Remember, that's hit a 6-month high this week. Rio looking good too. South 32 pretty flat, and Fortescue, which has changed its name to just Fortescue now, up by 1%, $25.16. And a quick look at the retailers, because I did mention, of course, the weakness we're seeing from a lot of them when they update their shareholders at AGMs. Harvey Norman, they're down by 0.4%. It is Black Friday, but hopefully some of those retailers will see some effects of that. Lovisa having a 3.8% fall. And of course, we've been following Nick Scali a lot this week after Anthony Scali sold down 50 million of his shares via UBS. What does he know that perhaps we don't? All right, let's have a look at some of the other top corporate stories. I mentioned Adairs holding its AGM, warning the cost of living crisis has impacted all 3 of its businesses. Adairs shares up by 1.4%. Wisetech Global also had its AGM today. It is the latest tech company to join the conga line of cost out programs, which is expected to deliver a net $15 million in savings in full year 24. We did see Wisetech down about 3.5%. Origin Energy, I mentioned, of course, that shareholder vote on the Brookfield's buyout now postponed until December 24. And just having a look at some of the other companies that we've been following. Virgin Money UK, their shares down by about 6%, following, of course, an update that it had in the UK overnight, its full year profit missing expectations.
It's a brilliant business. You know, you can't doubt that. It has been for quite a long time. But it's not cheap. You pay for that quality. $22 billion market cap, about 50 times EBITDA. And I think the concerns of the market is that as it's gotten bigger, that growth has naturally slowed. And in the past, most of that has been acquisitive growth. And, you know, it's hard to do that as you get bigger. Acquisitions either have to get bigger or you need your organic growth to sort of supplement. I have always appreciated CEOs, and you see it with founder CEOs who have that long-term mentality that they just tell you what the plan is and what they're going to do, and sort of let the market, you know, do what it does. And so that's why, as I said, I found that CEO address quite enjoyable to read. Richard's definitely got that sort of longer term focus. And so for the right shareholders willing to stomach some short term volatility, I think there's still a nice long term story here with Wisetech.
I think that Wisetech is not such a good quality business because its growth has been less organic compared to actually most of those stocks I named. It's organic growth, and organic growth is generally more of a sign of a competitive advantage than just a roll-up strategy. So I don't actually see it as really fitting happily into that group, but the market does. And in fact, everything you guys were just like Luke, what you were saying, sort of shows that is generally how people think of it. And at the risk of being wrong and a little bit contrarian, I actually don't think it's such a good business as everybody thinks. And as a result of that, I would actually say sell, and I don't hold it myself.
Welcome to the COB, our guest, Shane Oliver, AMP Chief Economist. And Shane, always good to see you. It's really going to be about what we see from the RBA in December. We heard from Michelle Bullock a couple of times this week talking about inflation being homegrown. We also, of course, have the upcoming retail sales data. What did you think of Michelle Bullock's speeches and whether or not we will see that December hike?
Look, I don't think we will see a December hike, but you'd have to say those speeches, there was the panel, then the minutes. I think I've got the order right here. Then the minutes, then, of course, the main speech on Wednesday night. I mean, the tone generally was hawkish. The Reserve Bank is concerned that inflation is increasingly demand-driven, focused on services in particular, which may be sticky. And the best way to respond to that, in their view, is with higher interest rates. Not necessarily the only way, but the only tool they've really got. So it does keep, I guess, investors on edge. It partly explains, I think, why the Aussie share market this week has been somewhat lacklustre compared to global markets. I think the US market week to date is up 0.9%. We're about flat. Likewise, from the lows back in October, the US share market is up something like 9%. Almost at an all-time high. I think it's only 5% away from an all-time high, whereas our gains have been a lot less than that. So the Reserve Bank is part of that. Other central banks are making more signs that they're at or close to the top, probably at the top, not necessarily rushing to cut, but at the top. Whereas in Australia, you've still got this high risk that they might move again. I don't think there was necessarily anything surprising in Michelle Bullock's comments, but you would have to say they were hawkish, and they do underline the still high risk of another hike. The reason I don't think they'll move in December is that I think next week's retail sales numbers will be on the soft side, consistent with what you were just saying about Adairs. And I think also the CPI number will show a monthly gain of 0, which will see the annual rate fall back to 5.2%. And just bear in mind, there are some very, very high numbers in the CPI applying in the December quarter last year, and also particularly on a monthly basis in November, December. They will start to drop out in the months ahead, particularly for the December quarter numbers, and that will lead to a further fall in inflation. So I think ultimately the RBA won't move again, but I've been too dovish on this, and the risk is still there that they may still move again, but I'd put the risk around 40%, 45% thereabouts.
I guess as well, Shane, it's not really as much as whether they move again, but how long rates stay here. And I mean, most market forecasters are saying we won't see any kind of cuts till February 25, whereas potentially you'll start to see the Fed move in June next year.
Yeah, that has a number of implications. If you look just over the last few weeks, expectations for the Fed, interest rates there, market expectations have sort of come down a little bit, if anything, whereas in Australia they've gone up a little bit. So the interest rate differential is sort of moving, it's still negative, but it's moving in the direction in favour of Australia, which partly explains why the Aussie dollar is up over the last few weeks, up around 65.50, where those lows were in the 62s. But yes, you're right. I don't think the RBA will wait all the way up to February 2025. I think we'll see cuts in the second half of next year, but we've got a long way to go to get to that point. We are clearly lagging the US. Our inflation rate is lagging the US by about 6 months. I don't think that necessarily means the RBA has to get a whole lot more cautious, because those high inflation numbers late last year will start to drop out. But nevertheless, yeah, we do perhaps have higher for longer. And we will probably lag the Fed in terms of starting to cut interest rates. Another implication from all of this is that it's starting to weigh on the property market. If you look at CoreLogic data so far this month, that they reported that we've gone to a record high on average. That's driven by particularly Brisbane, Perth and Adelaide. Sydney is still just below a record high. Melbourne is a fair way below a record high. But the momentum that we're seeing in Sydney and Melbourne has really slowed down since May. Look at auction clearance rates. They were 70 to 75% recently. On domain numbers, they've been around 60 to 65%. And it seems to me that the high interest rate environment is starting to get the upper hand again, whereas for much of this year, the property market has been dominated by the shortage of property in the face of booming immigration levels. So it looks to me like momentum is slowing down. Sydney is leading the way there, and therefore the risk of price falls in home prices next year, I think, is actually quite high.
Okay, let's talk about the overall markets. We're pretty unchanged over the course of the week, but in terms of some of the sentiment indicators, do you think potentially some of this so-called pre-Santa rally has got ahead of itself?
I think it has. It's interesting. It would have been nice when share markets were coming. I don't like bear markets. It makes me feel unhappy and all that sort of stuff. Most people don't like them unless you're short. But one thing with bear market is that it makes shares cheap, and sentiment gets washed out. So shares become undervalued and unloved. Shares did come down into October, but it's hard to argue they were dirt cheap. And sentiment came down from somewhat ebullient earlier this year to more averagey sort of levels. But they didn't quite, I wouldn't say they quite got to unloved levels. Now we've seen this bounce back. Sentiment towards shares has improved. But I think what's happened in share markets is that they've probably moved a little bit ahead of themselves, as you suggested perhaps in your question there. Share markets are now somewhat overbought. I wouldn't say sentiment is euphoric or anything like that, but it's not at the level you'd normally want to see the start of a major bull market or a continuation of a major bull market. So there is that risk of a short-term pullback in markets. And I'm also conscious that when you look at seasonality, we often look at it just on a monthly basis. November is the strongest month of the year in the US, followed by, I think it's December. And then January is usually pretty good as well. Interestingly, the period from in the first 2 weeks of December, which we're coming into, are actually a bit sideways on a seasonality point of view. The Santa rally really kicks in the last 2 weeks of December. And in Australia, seasonality really doesn't get that positive until we go into December. But I think the bottom line is, shares have run a bit ahead of themselves, could see a bit of a pullback, but I still think we're probably going to see a decent Santa rally into Christmas or into year end.
We've got to leave in a moment, but the people are asking, I'm not joking, Shane, people out there were saying you've got to ask him what's he reading, what's he listening to. I just saw Goldfinch from Donna Tartt behind you. That's one of my favourite books. But what is it this week?
Well, actually, I've got it here.
You've got it.
I occasionally get into... years ago, I read Tolkien, starting with The Hobbit, and then, of course, Lord of the Rings, and that was just fascinating. But ever since then, I've been periodically reading fantasy novels, and this is the one I'm currently reading, which is, hopefully you see the title there, Time of Courage by John Gwynne. I read the first two. Takes me a long time because you can see they're actually quite thick. I think this is 600 odd pages or something, but they're actually very good books. And once you get into these sort of fantasy novels, different worlds, all sorts of things going on, it's great bedtime reading, I find anyway. It helps me forget about financial markets and economics and what the RBA is going to do. And I can go off in a little fantasy world and fall asleep. All right. So that's where I am right now.
We need a bit of fantasy in these somewhat gloomy times. Thank you so much, Dr. Shane Oliver from AMP. We'll see you again next week. Quick look now at just some of the market moves and, of course, what we're going to see in the week ahead. We mentioned with Shane their retail trade, but these are some of their small cap movers today. 40 Medical. Now, I spoke to the CEO yesterday. That's a great interview. Have a look at it on ausbiz.com. Just the movement in terms of medical imaging and the fact that they've now got Medicaid support in the US. They're talking to Canberra about Medicare as well. Okay, now let's have a quick look at what we're seeing next week. There's some of the small cap losers too. But retail trade, as we mentioned with Shane, the monthly CPI, which we also mentioned, will feed into what the RBA thinks. Building approvals, the Judo Bank Manufacturing Index, private sector credit for October. And then when it comes to what we're looking out for in the week ahead, the RBNZ will have its decision. I mean, everybody pretty much thinks they're done now, looking more towards when they'll cut. China PMI, US GDP for September, the US Federal Reserve Beige Book, and new home sales for October and home prices also for September. So another busy week. We will, of course, keep you all across it here on AusBiz. And we also just want to give you a quick look at where the market is. Half an hour's trade to go, up by about 1/3%. And as I mentioned, that means that we're pretty flat on the week. And as we know, we're flat on the year. All right, that does it for the COB. But of course, the last call is coming up next. Going to throw it over to Nadine and Andrew.